Hey there, welcome back to the Street Smart Secrets, your trusted source for practical, powerful, and easy to understand financial wisdom. I'm glad you're here, because what we're about to cover could protect your wealth when the world's financial system gets shaky. Imagine waking up one morning to find your bank accounts frozen, your investments tanking, and your currency losing value. Scary, right? That's exactly what's happened in countries like Argentina, Lebanon, and Sri Lanka. And it could happen anywhere. But here's the thing. Some people always survive, not because they're luckier or smarter, but because they understand the assets, skills, and strategies that hold value when the system falters. If you want to learn how to protect yourself, spot opportunities, and stay ahead when others panic, make sure you hit that like button, subscribe, and turn on the notification bell so you never miss an update. Now let's dive in. 1. Skills, mobility, and optionality, the ultimate crisis asset. During every economic collapse, one truth remains constant. There is always a group that survives better than the rest. Who are they? They are the people who can move, earn, and adapt. History provides vivid examples. During the Great Depression, many skilled workers and artisans didn't just wait for government relief. They migrated, learned new trades, and rebuilt communities from scratch. They didn't rely solely on savings or property. They relied on their competence. In the chaos following the collapse of the Soviet Union, traders, engineers, and technicians who could leverage their skills in new markets thrived, while those who depended on state-assigned jobs struggled. Even today, in modern crises, remote earners and location-independent professionals can escape the worst effects of hyperinflation or currency collapse faster than investors clinging to local assets. Skills compound when systems break. In stable times, competence is valuable. In unstable times, it is irreplaceable. Governments may be able to tax your assets, freeze your bank accounts, rewrite laws overnight, but they cannot confiscate your ability to work, solve problems, or create value. This is why portable skills are so powerful. They generate income independent of location. They allow you to pivot into new markets, industries, or even countries. Mobility isn't just freedom, it's leverage. Optionality isn't just convenience, it's safety. Debt crises and economic collapses trap those who are immobile. If your wealth, income, and legal identity are concentrated in one place, your risk is enormous. Conversely, the most resilient and powerful people in unstable times are rarely the ones with the largest bank accounts. They are the most flexible, the ones who can earn anywhere, adapt to new rules, and relocate at will. Global elites understand this intuitively. They invest in multiple residencies across countries, offshore access, and diversified banking. Skills that travel with them. You are your most resilient asset. Money can disappear, markets can crash, currencies can fail, rules can be rewritten overnight. But if you can earn, adapt, and relocate, you always find footing. You are not at the mercy of institutions, borders, or failing systems. You carry survival, opportunity, and independence in your own competence. In times of collapse, this is more valuable than gold, cash, or real estate combined. It's why flexibility always outlives fortune. 2. Gold, the asset that survives broken promises. In 2008, when Lehman Brothers collapsed, the world watched something strange unfold. Banks failed, stock markets plummeted, governments scrambled to stabilize systems. People lined up outside banks, unsure if ATMs would dispense cash. Panic rippled through communities and boardrooms alike. But one thing didn't disappear: gold. While paper wealth and digital balances wavered, gold quietly did what it has done for over 5,000 years. It preserved value when trust in governments, banks, and currencies evaporated. Gold's power is not in its shine. It's in the fact that it has no issuer. Every currency you've ever used represents a promise. Gold is not a promise. It simply exists, immutable and universally accepted. Debt crises rarely announce themselves with dramatic defaults. Instead, governments often default silently. They print money, adjust rules, freeze accounts, or inflate away obligations. Gold sits outside all of that. It doesn't care who holds office, which policy changes are enacted, or which central bank panics overnight. Look at history. Empires collapse, Roman, Ottoman, British, and their currencies vanish, but their gold continues to hold value. During Argentina's hyperinflation, Venezuela's collapse, and Zimbabwe's currency meltdown, the people who survived financially weren't necessarily the smartest or richest. They were the ones who held something governments couldn't dilute: coins, jewelry, small gold bars, portable wealth that travels. And here's what most people miss. Gold isn't about chasing profit, it's about preservation. In calm periods, gold feels boring. That's exactly why it works. In chaos, what's boring becomes priceless. Central banks understand this intuitively. While telling citizens that gold is outdated, they quietly buy it and store it, knowing it is the ultimate safeguard against monetary collapse. Paper gold, ETFs, and digital claims, however, are still promises. They can fail. Physical gold cannot. Gold doesn't explode in value overnight. It doesn't follow hype cycles. It waits. And when confidence in currencies cracks, gold doesn't ask for permission. It simply retains its power, silently protecting those who hold it. In a world dominated by debt, leverage, and promises, gold is the ultimate insurance. Not flashy, not trendy, but timelessly reliable. 3. Cash, the most underrated crisis weapon. During every financial crisis, there comes a moment that terrifies even the wealthiest. They realize they are asset-rich and cash-poor. It's a paradox that has repeated itself through history. You may own beautiful homes, flourishing businesses, or a stock portfolio worth millions, but when markets seize up, those assets are effectively frozen. You cannot sell, you cannot transfer, and suddenly your wealth becomes almost meaningless. Take the COVID-19 market shock of 2020, for example. The global economy didn't freeze because companies were unprofitable. Many of them were fundamentally strong. They froze because they ran out of cash, the lifeblood of daily operations. Overnight, assets that looked secure on paper became illiquid, and owners realized that without immediate liquidity, even great assets could not keep their lights on. Cash is oxygen. Without it, businesses suffocate, opportunities vanish, and panic spreads. When debt crises hit, assets drop first. Stocks, real estate, and even businesses fall before inflation is obvious. The market punishes over-leveraged positions and forces liquidation. In contrast, those holding cash gain power because they can act when others cannot. They can buy properties at fire sale prices, rescue failing businesses, or seize opportunities that only appear in crisis. But not all cash is created equal. Weak currencies die first. Hyperinflation, devaluation, and capital controls often strike the most vulnerable currencies, leaving holders powerless. In contrast, strong, liquid reserve currencies survive the chaos. History shows that in moments of global panic, people flee to what they believe others will accept tomorrow. That is why the US dollar often strengthens during global crises, even when the US itself faces economic challenges. Cash grants optionality. It allows you to avoid panic selling at the bottom, wait patiently for opportunities, act decisively when others are trapped. Consider Cyprus in 2013. Citizens woke up to frozen bank accounts, unable to withdraw even basic funds. In Lebanon, depositors lost access to lifetime savings as banks collapsed. In Nigeria, cash shortages became political tools, affecting who could transact at all. The lesson isn't to blindly trust cash, it's to control liquidity. Cash itself does not make you rich, but it makes you dangerously powerful in the right moments. Every crisis creates forced sellers, businesses desperate for capital, property owners over-leveraged, investors margin-called. Only liquid, patient individuals can act in these windows. Cash is not flashy, but it is a survival tool. In debt crises, survival belongs to those who can wait. And cash gives you the ability to wait, calmly, strategically, and ready to seize opportunity when the world panics. Or, real assets with utility. When paper fails, life continues. When Sri Lanka's debt crisis exploded in 2022, it wasn't abstract economic ratios that hurt ordinary people. It was the collapse of essential systems. After borrowing heavily and depleting foreign exchange reserves, the government could no longer pay for imported fuel, medicine, and food supplies. With almost no dollars left to secure imports, long queues formed at fuel pumps, and fuel shortages forced rolling power cuts across the country. In some areas, electricity was rationed for up to 13 hours a day. And cooking gas, basic groceries, and medicines became scarce or astronomically expensive. For most people, the crisis wasn't about numbers on spreadsheets. It was about real, everyday shortages. Imagine being unable to drive to work because petrol has run out, waiting in long lines for a few liters of cooking gas, or coping with food prices so high that everyday meals become unaffordable. Even bread bakeries shut down due to lack of cooking gas, and hospitals struggled to perform routine procedures because they lacked essential supplies. This kind of crisis exposes the difference between paper wealth and real, productive assets. A portfolio full of stocks and bonds feels valuable until the lights go out and fuel is unavailable. When money loses its purchasing power and foreign exchange reserves are depleted, real human needs, food, water, energy, transportation, still must be met. That's why real assets with utility matter so much during instability. Food must be grown, not just priced in currency. Energy must be produced, not imported with dwindling reserves. Water must flow or not be rationed at the faucets. Throughout history, from Weimar Germany in the 1920s to modern Venezuela, those who controlled productive assets survived with a degree of dignity. Farmers could trade food. Owners of energy infrastructure could leverage supply. Landholders retained something tangible that could not disappear overnight. These are assets that rely not on confidence or financial engineering, but on necessity. Things people will always need, regardless of economic conditions. During crises, people stop buying luxury goods first, but they don't stop eating. This simple truth is why farmland, water access, energy infrastructure, and logistics networks become more valuable during unstable periods. Not because they're exciting, but because they are essential to life itself. Inflation often shows up here first, not on charts, but in grocery store prices and fuel queues. Real assets act as a mirror to inflation, reflecting the real cost of essential goods and services. And unlike digital numbers on a screen, they don't vanish during bank holidays or defaults. The key is utility, not speculation. Productive land, not empty plots. Energy generation capacity, not hype stocks. Assets that solve real problems, not promise profits. Debt crises ultimately reveal the difference between wealth on paper and comfort in life. Comfort can disappear quickly. But utility, assets that fulfill basic needs. 5. Bitcoin, a system that rejects debt entirely. It is important to distinguish between Bitcoin and crypto, as the two are often misinterpreted as the same thing, when in reality they are fundamentally different. Bitcoin was born in 2009, and not by coincidence. It emerged in direct response to the global debt crisis. The very first Bitcoin block contains a message referencing bank bailout, a quiet protest against a financial system where losses are socialized and debt is infinite. Bitcoin is not perfect. It is volatile. It is widely misunderstood, but it does something radical. It removes trust from money. No central bank, no bailouts, no money printing. In countries with capital controls, Bitcoin has already served as a lifeline. In places like Nigeria, Lebanon, and Argentina, people didn't turn to Bitcoin to get rich, but to escape financial cages. Bitcoin is not a short-term inflation hedge. It is a monetary escape hatch. Crypto, on the other hand, is something entirely different. Most cryptocurrencies function as access keys to use a platform, governance votes to influence rules, incentive mechanisms to reward users or developers, speculative assets designed to attract capital. Typically, developers create a blockchain or smart contract and then issue a token. That token is used to pay fees, vote on decisions, access features, reward participation. While the blockchain tracks ownership, the rules are still written and changed by humans. Think of crypto like shares, coupons, or arcade tokens, not cash. Most cryptocurrencies were created to raise money, build platforms, attract users, enrich founders and early insiders. As a result, they are often controlled by foundations, core development teams, venture capital firms. The distinction is simple but critical. Bitcoin is a monetary protocol. Crypto is an experiment. Some experiments may succeed, most will fail. If your goal is survival in a debt crisis, Bitcoin stands alone. Confusing the two is where most people go wrong. How Bitcoin rejects government debt. During every major debt crisis, the pattern is always the same. At first, governments reassure citizens, then liquidity tightens, then controls quietly appear. Withdrawals are restricted, Banks begin limiting transfers. Foreign currency access disappears. Money becomes trapped inside borders. This is not accidental. It is how debt-based systems defend themselves when pressure rises. When a government carries too much debt, capital becomes the enemy. Money leaving the system exposes weakness. So the system responds by locking money in. This is where Bitcoin breaks the pattern. Bitcoin does not sit inside the government's balance sheet. It does not rely on a central bank. It does not require permission from commercial banks. While fiat money exists as a liability of the state, Bitcoin exists as a final settlement asset. There is no issuer trying to manage debt, roll over bonds, or protect a currency peg. When currencies are trapped, Bitcoin still moves. A bank can deny a wire transfer. A government can freeze an account. But no authority can stop a valid Bitcoin transaction from being broadcast and settled on the network. This is not because Bitcoin is rebellious. It is because debt does not exist inside its design. Bitcoin has no bonds, no interest obligations, no refinancing cycles, no bailouts. Every unit is fully settled at creation. There is nothing owed to anyone else. This is why Bitcoin rejects government debt at the structural level. Debt requires control. Bitcoin removes control. But this power comes with responsibility. Bitcoin is not insurance. It does not stabilize prices. It does not promise comfort. It offers optionality, the ability to exit, move, and settle value when traditional doors close. Discipline matters because speculation invites punishment. Leverage, shortcuts, and custody through fragile intermediaries recreate the same risks Bitcoin was designed to eliminate. Self-custody matters because ownership in Bitcoin is literal. If you do not control the keys, you do not control the asset. In debt crises, intermediaries always protect themselves first. Bitcoin does not reward impatience. It does not reward ignorance. It rewards understanding. Those who chase price candles experience volatility. Those who understand why Bitcoin exists experience sovereignty. Bitcoin is not a trade. It is an exit. And in a world drowning in debt, systems that allow exit always matter most. And that's the reality most people ignore. Wealth isn't just about money on a screen. It's about assets that hold value, cash you control, skills that travel, and optionality that protects you when the system falters. The world of debt, inflation, and financial collapse can feel scary, but knowledge, preparation, and smart action give you power. If you found this video valuable and want to stay ahead of financial crises, make sure you hit that like button, subscribe, and turn on the notification bell. I post insights that can protect your wealth, sharpen your financial instincts, and show you how to thrive when others panic. Drop a comment below and let me know, which strategy do you think is the most critical in a global debt crisis? Gold, cash, real assets, skills, or Bitcoin? I want to hear your thoughts. Remember, comfort disappears quickly in crisis, but utility, liquidity, and adaptability endure. Stay prepared, stay disciplined, and stay in control. See you in the next video.